Aerospace and defense ETF soaring? For a bold trade in this sector, trade DFEN, Direction's Daily Aerospace and Defense Bull 3X shares. Don't miss your next big trade. Direction Leveraged ETFs.
An investor should carefully consider a fund's investment objective, risks, charges, and expenses before investing. A fund's prospectus and summary prospectus contain this and other information about Direction shares. To obtain a fund's prospectus and summary prospectus, call 866-476-7523 or visit us at www.directioninvestments.com. A fund's prospectus and summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors, such as traders and active investors. Distributor, Foresight Fund Services, LLC.
You're listening to the Index Investing Show. This is America's only weekly program focused on the important stock and bond indexes and the financial products that track them.
And now presenting your host,
Ron DeLegge.
Okay, coming up on today's program, we're going to check the health of this particular stock market to see if it's healthy or sick and if it's in imminent danger of ending. Also coming up, we're going to share some tidbits with you from the just released September issue of ETF Guide Premium. If you'd like to join us to talk about any particular stocks, mutual funds, ETFs, or financial strategies, we can do that. 844-305-7800 is the number. We're also going to check the Twitter feed a little bit later. I'll tell you what's going on there. So, taking a look at what's going on in financial markets, I mean, has anybody bothered here in the doldrums of summer, have they bothered to look at their investment portfolios and see what's going on? Has anyone done that? Because if you haven't, well, I would say now more than ever is a good time to do that because stock market conditions are favorable. And that's the time you want to be making adjustments, making tweaks, and identifying problems, if there are any, inside your investment portfolio. You don't want to be doing this when it's raining cannonballs from the heavens. So we want to help you understand what's going on with your portfolio. One of the things that we do on this program quite regularly, an exercise that was meant to help you to understand what are the metrics that determine a well-built, architecturally sound investment portfolio from those that are not, is Ron DeLegge's portfolio report card. And I've been doing this for several years now, and it's basically a very simple exercise of where I analyze and actually grade investor portfolios right on this program. And so one of the things I've done over the past few months is we've expanded this, and I'm now teaching financial advisors how to analyze and grade investment portfolios using the portfolio report card grading system, because it is a powerful diagnostic tool for telling you exactly what's going on with your money. So if you have not yet taken up my challenge, I will challenge you to a duel. Go to portfolioreportcard.com and take my challenge. If you get an A, I pay you $100. And if you don't get an A, well, then at least you learned and figured out exactly the strengths and the weaknesses of your portfolio, which I will exactly tell you. So let's talk a little bit about today's subject, which is I want to do a checkup on the financial health or the health of the bull market. So that's what I want to do on today's show. And we're going to look at this. We're going to slice this up and look at this, dissect it from a couple of different angles. We're going to look at corporate earnings. We're going to look at the price momentum of stocks. We're going to also take a look at the sector momentum. What are the industry sectors telling us? We're going to take a look at market sentiment. And then we're going to arrive at a conclusion that is either the market, the bull market is healthy and it's going to continue, or imminent danger is upon us. So that's one of the things we're going to do on today's show. Also, from ETF Guide Premium, this is the September issue. It just got released this weekend. And we always, when we put together ETF Guide Premium, we always release it early so that you get a jump on the markets, you get a jump on everyone else. So the September issue is already out, even though it's still August. In there is a wonderful quote from J.P. Was it John Paul Getty, one of the tycoons of the previous era, a bygone era. If you haven't been to his museums, by the way, in California, they're absolutely beautiful. He's got two of them, and I've been to both of them. And the one in Malibu, that was his mansion, and he actually never saw the completion of that or actually enjoyed it. He died prematurely, but he's also got another one, which is newer, in, I believe it's Brentwood, and it's unbelievable. You get the best views of Los Angeles from the one in Brentwood, but the one in Malibu has arguably excellent views, of course, of the ocean, but it's a much smaller, intimate type of environment, the one in Malibu, but both highly recommended. But this is what J. Paul Getty had to say. He says, if you owe the bank $100, that's your problem. If you owe the bank $100 million, well, that's the bank's problem. And that's a quote highlighted in the September issue of ETF Guide Premium, just pointing out the issues of too much debt, excessive debt, and whose problem that becomes when it really gets out of control. Now, one of the other things that are discussed is something called an inverted yield curve. So, you got to ask the question, because I've seen this as of late in the media, are interest rates flashing a warning sign to the stock market? Now, in case you missed it, the yield curve just narrowed to its flattest margin since just before the onset of the 2008 financial crisis. Now, the difference between the yield on the 2-year and 10-year U.S. Treasury declined to just 25 basis points, or 0.25%. Now, that's the flattest since August of 2007, which was, by the way, in case you forgot, just 2 months before the S&P 500 began its epic decline. So what does this mean? What does this portend for financial markets? Well, an inverted yield curve happens when shorter-term bonds like the 2-year U.S. Treasury carries a higher yield than long-term Treasuries like the 10-year note. So how accurate has this indicator been? Well, the inverted yield curve has correctly predicted each of the past 7 recessions going back all the way to 1968. That's a pretty impressive prediction rate. So 100% accurate, going back to 1968. So the question then becomes, is it time now for investors to bail on stocks? Is this an ominous sign for stocks? So the answer to that question, as with all indicators, the inverted yield curve, and I can't emphasize this enough, an inverted yield curve should be considered in the context of other key data, not, and I emphasize, not as a standalone decision-making tool. And this is where many traders, where many investors trip themselves up, and they mess up by extracting one indicator, which has a very, as you see, a very powerful historical prediction rate of being accurate. But they extract that one piece of data, that indicator, and then they go hog wild basing their decision-making on that one indicator, while completely ignoring the context of the other key data to see whether it confirms or denies that viewpoint that they have and the decisions that they should be making. So, yes, the inverted yield curve right now seems to be pointing to problems ahead for the U.S. economy and possibly even the stock market. However, we're going to do a checkup on today's program of the market. We're going to take a look at a couple of key areas, and we're going to look at it and compare whether it's telling us an imminent decline is upon us. I'm Ron DeLegge. This is Index Investing Show. I'll be right back.
The Index Investing Show with Ron DeLegge.
Stop investing blindly. Listen to the Index Investing Show with Ron DeLegge every week on iTunes and IndexShow.com. Learn how to grow and protect your money.
All right, the phone lines are open, 844-305-7800. You can also tweet the program at Index Show. That's where you find us on Twitter. Now, taking a look at some of the key indicators in terms of price performance, the beginning of the year, the S&P 500, which tracks a basket of large company blue chip stocks in the U.S., ahead by almost 8% since the beginning of the year. Total U.S. bond market, ticker symbol BNB, down about 1.1%. VEA, which tracks developed international stocks, down around 4%. Emerging markets are struggling. VWO down just over 9%. And then, of course, global real estate is ahead by just over 3.25%. So that's what's going on there in global markets. How is your portfolio doing? How is your portfolio doing so far? We give you this so that you can look, see, and compare your own portfolio to the performance that I've just given you. I mean, it's just a guideline. It's just a benchmark, and so that you can understand what's going on with your own investments. So we try to help you have some context so that you look, see, and compare the performance of your own investments versus these major benchmarks. Now, one of the topics we're discussing on today's show is we're doing a checkup to see the health of the current bull market in the U.S. stock market. Is it healthy, or is it in imminent danger of collapse? And as I indicated in the previous segment, we've been sharing some tidbits with you from the ETF Guide Premium, which was just released in September at etfguide.com to premium subscribers. Now, we talked about the inverted yield curve, which has been an accurate indicator. It's predicted correctly 7 of the past 7 recessions, going all the way back to 1968. But the question is, how long will the rally in stocks last? The fact that we've got an inverted yield curve right now, we've got short-term bonds like the 2-year Treasury carrying higher yields than long-term Treasuries. You know, how long? And of course, this has been narrowing too, right? It's what we call a flat margin, and it's been narrowing the most ever since just before the 2008 financial crisis. So we're going to look at a couple of things. First of all, corporate earnings, right? Our corporate earnings, because here's the thing, is if corporate earnings were in trouble or declining or decelerating, that would be a big problem for a stock. But the question is, how are corporate earnings looking? What has been the result? Well, thus far, for the second quarter, S&P 500 companies, 91% of them have reported second quarter earnings, and the results have been very strong. Earnings growth rate for S&P 500 in the second quarter jumped to almost 25%. They were projecting just a 20% growth rate at the end of June. Well, that's a pretty big margin of outperformance in terms of earnings growth rate, just beating expectations by a pretty considerable margin. going from 20 to 25% earnings great growth rate. That's pretty significant. I know it may sound small, but it's not. We're talking billions of dollars of earnings, and to go from a 20% expected growth rate to 25% is pretty huge. There have been scattered misses on second quarter earnings. I know that. Yeah, Facebook missed, and some other companies out there have also missed. But the overall trend, and this is what you have to look at. You can't just extract one or two companies and say, oh, corporate earnings were bad for Facebook, or they were bad for whoever else. You've got to look at the overall trend. Give me some context. Unless corporate earnings start to decelerate in a widespread manner, which they're not, the latest results for the second quarter in terms of corporate earnings do not paint a bearish scenario for stocks. So that's the first thing, corporate earnings. We're going to take a look at some of these other areas like price momentum, sector momentum, and market sentiment. 844-305-7800 is the number. You're listening to the Index Investing Show. We're here every week teaching you the birds and the bees of successful investing. And one of the things that I've done is I've put together some online classes that are designed to help you manage and build your own portfolio. Even if you've got a financial advisor, it's important that you talk to that advisor in a manner that's educated, that you understand things like fees, that you understand things like asset mix and diversification and tax efficiency and performance. And so I've got some great online classes. We've had students sign up from all over the nation and actually all over the world. Anywhere you are, as long as you've got an internet connection, you can enroll in my online classes and begin to be tutored and learn on how to build and manage your own portfolio, how to protect your money, especially those of you getting near retirement. You know, it's not just about, for so many years it's been about growing your money, but now your investment goals are changing. Now it may not be so much about the growth of that portfolio, but the safety of that money and making sure it doesn't get cut in half. So what are some techniques that you can utilize to protect your money? Yeah, you want growth, but you also don't want to get bombed out. So you can go to indexshow.com and scroll down, and you'll see some of my online classes. Hit the link, and you can read up all about them. I've also got some introductory videos that kind of give you a overall picture of what each of the online classes covers. So let's take a look at the Twitter feed. What's going on at Twitter? @Index Show is my Twitter handle. I've got a link to the latest risk management techniques being used by Wall Street. This is from BlackRock, the world's largest asset manager and the largest foreign holder of Turkish government bonds. Oh, my goodness. What a mistake that's been. Investing in Turkish government bonds. Turkey is in financial crisis. Their currency has been falling from the sky, and debt is ballooning. They've got political chaos. They've got economic chaos. They've got social chaos. It's the perfect recipe if you're a bear. And prices of Turkey, anything related to Turkey, has been crashing. And so BlackRock's been getting crushed. They've been running an outsized position in Turkey in some of their actively managed funds when the crisis hit about a week or two ago. Pretty amazing. Not a good time to be running outsized positions in anything related to Turkey, especially at this precise moment. But, that's how it works. That's how it works when you are investing in actively managed products that are attempting to outperform an index or benchmark. Is you're overweighting or underweighting certain areas of the market in order to try to outperform. And sometimes it works, and sometimes, like right now, it doesn't. And right now, for BlackRock's emerging markets local currency bond fund, it fell, according to FactSet, just over 7% for the month of August. August isn't even over. In terms of equity prices, the iShares MSCI Turkey ETF, ticker symbol TUR, is now down 49.5% since the start of 2018. It is just getting killed. I'm Ron DeLegge. This is the Index Investing Show. More when we come back. Go nowhere.
The Index Investing Show with Ron DeLegge.
Are emerging markets on the move? For bold trades on emerging market stocks in either direction, trade EDC or EDZ. Directions Daily MSCI Emerging Markets Bull and Bear 3X shares. Don't miss your next big trade. Direction leveraged ETFs.
An investor should carefully consider a fund's investment objective, risks, charges, and expenses before investing. A fund's prospectus and summary prospectus contain this and other information about Direction shares. To obtain a fund's prospectus and summary prospectus, call 866-476-7523 or visit us at www.directioninvestments.com. A fund's prospectus and summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors, such as traders and active investors. Distributor, Foreside Fund Services, LLC.
You're listening to the Index Investing Show with Ron DeLegge. Go to indexshow.com to enroll in Ron's online classes for investors. Learn how to grow and protect your money.
All right, welcome back from the break. By way of reminder, you can go to, this is for our podcast. If you ever missed the regular radio broadcast, you can go to indexshow.com. You can listen right there online. We archive every single show that we do. And we also post the broadcast via podcast at iTunes, as well as SoundCloud Radio, Google Play. So if you cannot find the Index Investing Show anywhere, well, then it's your own fault, because it's pretty much everywhere. So just search under Index Investing Show. You'll find us. And that way, you'll never miss our regular radio broadcast. 844-305-7800 is the number. At Index Show is my Twitter handle if you'd like to get in. If you want to get a portfolio report card where I analyze and grade your investments in 5 key areas, A, B, C, D, or F, I'll tell you what kind of grade your portfolio gets. Go to portfolioreportcard.com and get in touch with me. On next week's program, we're going to have Sylvia Jablonski with us. She works at Direction Investments. We're going to be talking ETF investing strategies with her. Also, on next week's show, we're going to do Portfolio Wars, where I take 2 investor portfolios, 2 listener portfolios, and we compare them and see which one wins, which one is better. So stay tuned for that on next week's program, Portfolio Wars, just like a video game. This is going to be fun. So don't miss next week's show. Now, if you're just joining us, we've been talking about a lot of things. We've been talking about the inverted yield curve. We've been talking about some things related to whether the stock market, its health, particularly the bull market, is still good. And we looked at the corporate earnings, which continue to be quite strong. Corporate earnings are doing very well. We have second quarter earnings growth of 25% for S&P 500 companies. That's outstanding. That is fantastic. That is not the sign of a bear market by any means. And certainly if we're going to have a bear market, then you've got to see at least deceleration in corporate earnings, not acceleration, which is what we see right now. So let's take a look at the next area. Let's talk about price momentum. What is the current price velocity of stocks? Is it up or is it down? So one yardstick that I like to keep track of is something called the iShares MSCI USA Momentum Factor ETF. And the ticker symbol on that one is MTUM. And I like to use this one because, as its name indicates, momentum, it tells us whether the momentum is up, bullish, or down, bearish. The fund owns mid and large cap U.S. stocks that have appreciated in value over the past 6 and 12 months. Now, since the beginning of the year, MTUM has outperformed the broader U.S. stock market. It's gained around 11% compared to a gain of around 7% for the total U.S. stock market. Now, MTUM also trades well above its 200-day moving average, which from a technical analysis perspective is another bullish sign that U.S. stock prices, at least among the ones with the highest momentum, because that's what MTUM owns, is still on the rise. And so in terms of a price momentum perspective, stocks, the ones that have gone up, are still going up. They're not done. And so that's, I think, a good sign for bulls. The next area is sector momentum. So what is sector performance telling us? So think about this. Let me help you understand this. If the stock market is on the verge of an imminent crash, as your neighbor or as your coworker or as that taxi cab driver or your Uncle Pete may be saying, get out of stocks, we're on the verge of an imminent crash. If that is in fact true, shouldn't warning signs among key industry sectors be evident? Shouldn't we see at least prices that are correcting? Do we see that, though? Well, if we look at the 10 industry sectors within the S&P 500, 10, we've got 7 that are ahead, right? 7 out of 10, so that's the vast majority. Standouts like consumer discretionary, XLY, healthcare, XLV, technology, XLK, have even beaten the broader U.S. stock market by a significant margin. The only 3 S&P 500 sectors that are negative year to date are consumer staples, ticker symbol XLP, industrials, XLI, and materials, XLB. Now, I know bears may be saying, oh, look at that. You know, you got 3 that are already down, 3 industry sectors within the S&P 500 that are down. That's bad. There's more to come. Well, look at the losses, though. How deep are the losses? That's the next question. Because we can't just say, oh, the losses, they're posting losses. Well, losses, if you take a closer look in XLP and XLI and XLB, have been modest, thereby muting the impact on the overall U.S. stock market. So let's have some context. Let's not just extract data that supports our own personal biases because we feel a certain way. We gotta deal with the facts and look at the facts. And right now, as you're seeing, we're doing a checkup on the health of this stock market, U.S. stock market, not talking global stocks. We're just focused on U.S. stock market. Right now, based on corporate earnings, based on price momentum, based on sector momentum, it's still a very positive story, a very positive picture. In the next segment, we're going to take a look at one final area, though. We got to take a look at the market sentiment or the mood of the market. What are traders, what are investors, what is their mood telling us about the current trajectory of market prices? So stay tuned for that. We're going to take a look at that. Also, if you'd like to join us, you still have time to get in. 844-305-7800. If you want to talk about any particular stocks, mutual funds, ETFs, we can do that. Just give us your first name along with your city and your ticker symbol. So, again, 844-305-7800. Back to our Twitter feed, something else that we've got. I have an article. William Shatner, does anybody remember him? I'm not a Star Trek, what do they call them, Trekkies? a Star Trek fan. Never really was able to get into it. I'm more of a Star Wars kind of person, but there's a lot of Star Trek fans out there. So William Shatner, there was an interview with him where he revealed his absolute best and worst personal investments. And so you can check that out on our Twitter feed. It was a very interesting read. And I always love the honesty when we see these interviews where people aren't just telling us, they're not just blowing smoke about all the wonderful and great things that they've done with regard to their investments, but also their mistakes. Because let's face it, we can learn from those mistakes. The goal is not to repeat those mistakes. Some of us haven't learned that yet. Some of us keep making the same mistakes over and over again. And that's called perfecting your mistakes. When you repeat them over and over again and you don't learn from that, you're perfecting your mistakes, which is a mistake in itself. But anyway, William Shatner, star of Star Trek, revealing his best and worst personal investments at Index Show. That's on our Twitter feed. This is the Index Investing Show. I'm Ron DeLegge. Stay with us. I'll be right back.
Show with Ron DeLegge.
You're listening to the Index Investing Show with Ron DeLegge. Go to indexshow.com to enroll in Ron's online classes for investors. Learn how to grow and protect your money.
All right, welcome back from the break. This is the Index Investing Show. We're pleased to have you with us. 844-305-7800 is the number. If you'd like to join us, give us your first name along with your city, and we will get to you. Now, we've been talking about a number of things on today's show, including doing a checkup on financial markets to see what their health is. Is the health good? Is the health bad? And so far, I think the evidence, the diagnosis that we've been doing here on the U.S. stock market right now, the diagnosis is pretty good. At the same time, we're not by any stretch showing overconfidence, because that could change on the dime. We're not going to be, Ron DeLegge's not going to be Irving Fisher, okay? You don't even know who that is, do you? Irving Fisher was the famed U.S. economist who, less than 2 weeks before the 1929 stock market crash, famously declared stocks had permanently reached a high plateau. Pretty bad timing, saying that right just before the 1929 stock market crash, 2 weeks. So that pretty much is what Irving Fisher's remembered for. No one remembers his other work. But the point here is we've got to look at the evidence. And the evidence right now still shows that U.S. stocks are in acceleration mode. Now, it is, I understand this, been a run, a bull market run of unbelievable number of years. I mean, what is this going to be, 9 consecutive years? If we continue as we are right now, 2018, that's going to be what, 9 consecutive years that U.S. stocks have increased in value. So eventually that will come to an end. There's no doubt about it. In fact, it's guaranteed. But at this moment right now, we talked about corporate earnings, very good. We talked about price momentum, still very good, even though obviously we have daily ups and downs and wild swings. Price momentum is still up. Sector-wise, we drilled down. We already looked at the 10 industry sectors within the S&P 500. 7 out of 10 are up. That's positive. How could you possibly interpret that to be negative if you're a bear? I mean, you've got to be blinder than a bat to be taking the sector performance as it is right now and somehow interpreting that to be negative. It's not. It's not negative. It's quite positive. And if you're going to short this market with 7 out of 10 sectors in positive territory, If you're going to short this market, especially with leverage, you're stepping in front of a freight train, and that's not going to work out very well for you. Now, the final area I want to look at is market sentiment, because that tells us a lot. What is the stock market's mood? What is its sentiment? And is there trouble ahead that might be brewing? So, if stock prices are overinflated to the point of a looming explosion, that should be obviously reflected by overly bullish extremes. So what are the indicators saying right now? Are they showing overly bullish extremes with an emphasis on extreme? Because it's one thing to be a bull, and it's a whole other thing to be a extremely bullish individual or person. And so the way that the CNN Fear and Greed Index looks at it is by fear and greed, right? So overly bullish would mean overly greedy. Overly bearish would mean overly fearful. And so right now, the current reading for the CNN Fear and Greed Index is neutral. We're right now at neutral. So, and it's, by the way, those of you wondering, well, what is the Fear and Greed Index? What is that all about? Well, it's an indicator that is a composite of 7 different factors, including stock market breadth, safe haven demand, and market volatility. And it's based upon current levels taking a look at those current readings. And so the point here then is that based upon current levels, stock prices do not reflect bullish extremes, because right now the Fear and Greed Index, according to CNN's readings, is neutral. So the summary of this is that it has been a long time since the last bear market. And the longer it's been since the last bear market probably means the sooner that the next one will be or will happen. And it will happen. It's guaranteed to happen. You can write that in stone. It's happened before in the past, and it will happen again in the future. There's a lot of Kool-Aid drinkers in bull market camps that believe that it will never happen again, or that the losses will be modest, they will be tolerable. No, they won't be. The next bear market will make you, just like previous bear markets, it will make you want to throw up. It will make you sick to your stomach. And it's going to happen. It's guaranteed to happen. But until then, the indicators right now clearly say, and this is the diagnosis, that the bullish trend in stocks is not yet over. Or as Mark Twain might say, because we love the poets on this show, love the poets, the artists, and the musicians. I've always been attracted to them personally, more so than the engineers and the mathematicians. Well, the mathematicians are a little bit crazy, so I kind of like them too. But the point is Mark Twain said, we're kind of twisting his quote, but reports of the stock market's death have been greatly exaggerated. So that's the current situation right now, and we hope that that's helped you understand that we may have, at least through the end of the year, a continuation of the upswing. And so that's what we're seeing. We talked about some of those key sectors. In terms of leverage performance, I always talk about the time and place for using leverage. You want to do it in industry sectors that are in a sharp uptrend. And 2 sectors we see that are doing really good are technology and healthcare. And those 2 sectors, the direction, technology, bull, 3X shares, TECL, ahead by 37% since the start of 2018. That's a delicious return. CURE, that's an easy ticker symbol to remember, ahead by 25.5%. That aims for triple daily performance, bullish to healthcare stocks. That's been a great trade. Those 2 for you bulls, if you're going to be using leverage, that's probably the right place and right time to be using it. And then how about the broader S&P 500? If you've been using leverage there too, that's been a great trade. SPXL, which aims for triple daily performance to the S&P 500 ahead by just over 15%. Now, something for you bears, because I know that we don't want to forget you. There's something for you because, you're always looking for the markets that are crashing. Well, you want to take a look at emerging markets, which earlier in the year, I was actually bullish on emerging markets, but that began to change once prices turned negative. And EDZ is the ticker symbol for the daily emerging markets bear 3X shares. EDZ is ahead by over 20% since the start of the year, and man, it's been jumping, especially since Turkey, which is an emerging market country, along with some of these other emerging market countries. Latin America's been a pretty nasty, ugly performer in 2018, especially Brazil. So that's why EDZ has been doing so great. It aims for triple daily opposite performance to emerging market stocks. When they fall, EDZ climbs as it was designed, and it aims to do that with 300% daily leverage. So that's been a good trade, and emerging markets have been trending down sharply. Coming up on next week's show, we're going to be with Sylvia Jablonski. She is from Direction Investments. We'll be talking about ETF investing and trading strategies. Also, portfolio wars. We'll be doing this for two listeners on the show. We'll be pitting them against each other. Who's got the better investment portfolio? You'll find out in next week's show. At Index Shows, where you find us on Twitter. We'll see you again next week.
The opinions expressed in this broadcast are not necessarily that of our advertisers, sponsors, or broadcast partners. The discussion of investing is general and should not be construed as investment advice or an offer to buy or sell securities. Listeners are responsible for their own investment decisions and results. Before investing in mutual funds or ETFs, always consult a prospectus for risk, charges, expenses, and other information. Read the prospectus carefully before investing. Past performance is not indicative of future results. No reproduction or dissemination of the Index Investing Show is permitted without the expressed written consent of its producers.